Stacey. I'm energy correspondent at the Financial Times. This session is about investment and climate change, something I'm sure a lot of you have started to think about, not least in the wake of the Paris talks. Mark Carney, the governor of the Bank of England, infuriated some and made others overjoyed last year when he warned that investors could face potentially huge losses by investing in fossil fuels that are then left in the ground because of action to tackle climate change. Whether or not you agree with his comments or even with his right to make them, climate change is becoming more difficult for investors from all sectors to ignore. Put simply, if an issue can unite nearly 200 leaders from around the world with the Paris Accord, it can probably drive the returns you get on various different classes of financial investment. To talk about this, we have first of all Christiana Figueres, the Executive Secretary of the UN Framework Convention on Climate Change, and therefore the woman responsible for brokering the recent Paris deal. Or as The Guardian put it more succinctly recently, the woman tasked with saving the world. Given the success of the Paris talks, I'm not sure whether she's now earned her promotion to the woman who saved the world, but I guess we'll find out. We also have Jane Ambachtsheer, a partner and chair of responsible investment at Mercer, and a member of the new task force on climate-related financial disclosures set up by the FSB under Mark Carney's leadership. And we have David Adkins, chief investment officer of the Pensions Trust, and we have MacDonald, the chair of the Institutional Investors Group on Climate Change. But without further ado, and because you don't want to hear from me too much, I'll hand over to Christiana Figueres. Thanks very much.
Thank you very much, Kiran. If you don't mind, I will speak from over here. So good afternoon to all of you. It's quite wonderful. I've come to Scotland many times and never to Edinburgh. So I'm quite delighted by your invitation here. It's a first for me, but it's also almost the first of having, as I was just saying to David, the exact opposite situation that I usually have of audiences who are deeply steeped in climate change and completely ignorant on finance. And here we have exactly the opposite. So I think the challenge is for me today. Let me start by giving you a truism and a data point, both of which should be quite known to you. The truism is that we cannot build what we do not finance. And the data point is that, at least according to the New Climate Economy Report, and you could agree or not agree, but at least according to them, we will be investing $90 trillion over the next 15 years, mostly into infrastructure, mostly in developing countries. So for me, even if you discount that and say, okay, it's not 90 trillion, it's 80 or 70 or whatever, the point is we are going to be making this major investment, and therefore the choice is what kind of investment, what kind of infrastructure are we going to choose? Because for me, it really is about a choice, and it should be for all of us about a choice. And it's a choice, frankly, that should be informed by our understanding of risk. First, physical risk of climate change impacts. If we do not address climate change in a timely fashion, should we go above 2 degrees, the insurance sector has already reached the conclusion that a world that goes above 2 degrees is uninsurable. How do we live in an uninsurable way, in an uninsurable world? And they have reached that conclusion because they've been able to project the intensity and the frequency of physical impacts and know that they would just simply not be able to insure. So that's the physical risk. And the second is the financial risk. And there, you know, the stranded asset literature, I'm sure, is known to all of you. And I think the $400 billion that have been taken off the table in CapEx in the oil industry lately, not because of climate, but because of the very low price on oil, is very indicative of what we could be seeing. Loss in value over time because of climate. And for me, I think what that is doing is putting a warning label on, certainly on high carbon, high cost investments, very similar to the warning label that we put on cigarette boxes a couple of decades ago. Label, smoking can be dangerous to your health. Well, label to high cost, high carbon, these investments can be dangerous to your financial health, to your economic health, and certainly to the world. So I would like to make 3 points for you today. I'm going to argue that A, we are already in a financial transition, already in a transition toward green finance. First. Secondly, I'm going to argue that the Paris Agreement recently adopted actually calls for deepening that transition. And then finally, suggest what the role of long-term investors can and should be. Before Paris, to just speak about the transition, before Paris, 2 quick data points. We already had $300 billion going into renewable energy. Not enough, certainly, but already certainly more than we had before. And we had $40 billion, very, very small in green bonds. Using Paris as a galvanizing moment for the financial sector in particular, we had, first, on the part of regulators, we've already heard Mark Carney speak very, very eloquently about the tragedy of the horizons and put together his task force that, under the leadership of Bloomberg and with Jane's wonderful participation, are going to be presenting their first report in April. But not just the Central Bank of England. During Paris, we had Swedish financial regulator, the Dutch financial regulator, the French financial regulator, all of them calling for more disclosure and stress testing of investment portfolios. Leading in a way to the Montreal Carbon Pledge, 120 investors that have already pledged to disclose the carbon risk of their portfolios of $10 trillion in assets. Then we have tools, a growing number of tools that are already being put on the table in order to be able to help decisions in investments. So first, I would say low carbon indices, whether it's by ET, MSCI, the FTSE, and the New York Pension Fund actually investing themselves $2 billion into their own index because they feel that they want to own this index and they're beginning to apply it. It's going to be, as I'm sure you all know, designed by GSAM. So, you know, a certain number of players already beginning to invest their own money into the tools and using those tools. And you have then, as a result of all of that, the Portfolio Decarbonization Coalition, 20 investors with $3.2 trillion already pledging to decarbonize at least $600 billion in their assets. You have Caisse de dépôt saying they're going to invest into $15 billion into green investments by 2017, and the list goes on and on. The Norwegian Sovereign Wealth Fund pulling out of 27 companies heavily invested in coal. So you get the flavor. That is certainly not an exhaustive list, but you get the flavor that there is a transition going on. To my point number 2, what did the Paris Agreement do? The Paris Agreement, I believe, calls for a deepening of this transition. First, because it brings together, out of 196 countries, 189 countries that have put forward their climate change plans out of their own interest, the kinds of investments that they want to do. Those are not bankable documents. Let's call them bankable documents, but that need the support of different actors to actually bring them to investment grade documents. But at least it already is a menu. So you don't have to scrounge around. You already know in 189 countries what they're intending to do and can already begin to plan for that kind of investment. Secondly, the Paris Agreement actually set a very, very immediate timeline, 2018, which is only 2 years away, in order to have a checkpoint there of how are we doing on the progress on meeting the decarbonization goals and setting out a path, a multi-decadal path of constant improvement. Read, we are decarbonizing the economy. That is by now unstoppable. The direction of travel is very clear. The only thing that can still go one way or the other dangerously is the pace of that decarbonization. But decarbonization, we're going to have. The third thing that the Paris gives us is it gives us a final destination. And the Paris Agreement, adopted by all 196 countries, says we're going to be, by the second half of the century, which is only 35 years hence, we're going to be at a balance, an ecological balance, where we will only be emitting those emissions that we can actually absorb naturally through the planet. So that net zero emissions is something that we need to begin to incorporate how, and many of the companies, manufacturing companies, are already putting themselves onto the net zero path, and it's something that the financial sector should be looking into as well. Let me just give you a very simple equation from my perspective, because I don't understand anything about math, less about investment, but here's a very simple equation. The quality of investment over the next 5 years globally equals the quality of energy because of lock-in and cycle, the quality of energy over the next 30 to 50 years, and that equals the quality of life on this planet for your lifetime and your children's lifetime. That really is an amazing, amazing responsibility that is on the shoulders of those who are making investment decisions over the next 5 years. So to my third point, what does this all mean for long-term investors? Well, first it means that there is an astonishing alignment here in the time scale. We're not talking about short-term liquidity here. We're talking about your capability to retain assets longer than other market players. That is the time scale that we're talking about, and that should be defining the kinds of investments that go into green finance or clean finance. And the second alignment is an alignment of asset type. We're not talking here about corporate bonds, about private equity, much less that. We are talking about infrastructure. And if there is any sector in the financial world that has the capability, and in fact has even the needs to invest in assets that match your liabilities, both in duration and in liquidity, well, it's the long-term investors. Now, paradoxically, institutional investors are certainly, as you well know, you are the largest investment sector, but you are, comparison to the size, the least engaged in climate finance. I'm here to ring a bell of alarm for you and to tell you frankly that that can, should, and must change because of the risk. Because of the risk to the global economy. That's why. You can add a whole bunch of other, moral arguments, let's leave those aside. Just because of the risk to the global economy, that really does have to change. Now, you are, as long-term investors, the best positioned to make a choice into what kind of infrastructure we're going to build in the next 5 to 10 years, as I have pointed out. You play an extraordinary role in stabilizing the economy over the long term. And I'm sure you're aware of the fact that central banks, who usually play that role, complementing yours, have actually run out of ammunition. They have reduced interest rates to the point where some of them are paying negative interest rates. What kind of financial world do we live in that now we have negative interest rates? And thirdly, the global economy is truly paralyzed. You understand that much better than I. So I ask you, has history not shown us that in moments of global paralysis in the economy, such as what we have after, for example, world wars, is not a massive investment in infrastructure? Is that not what actually gets us out of a paralyzed economy, such as what we did to reconstruct Europe after the Second War, and now what we have the opportunity not just to reconstruct one continent, but to reconstruct the world, and to reconstruct this world into the new economy that will be with us at least for 1 century, if not more. In the north, in the global north, all of the infrastructure is aging. You know that better than I. And in the global south, there is an absence of infrastructure because of the growing demand of population and energy that we're going to be seeing over the next 5, 10, 20 years. So a huge, huge opportunity for you to be playing your role in history to your own advantage. Thank you very much.
Thank you very much, Christiana. David, if you wouldn't mind taking the lectern.
Good afternoon, ladies and gentlemen. Firstly, let me congratulate Christiana and her team at the United Nations Framework Convention on Climate Change on delivering a successful outcome at the Paris negotiations. This agreement will have far-reaching implications for the companies and assets that we, as pension funds, invest in. So how should we, as managers and trustees of pension funds, respond to the theme of climate change and the outcomes of the Paris Agreement? In the time allotted to me, there are three important messages that I would like to convey to pension fund trustees and investors. The views expressed are my personal ones. My first point is this: treat climate change risk like you would any other significant risk. Climate change risk is not going to go away soon. 196 world leaders did not turn up in Paris on a whim. They did not turn up in Paris to rubbish the science. They turned up to debate their individual and collective responses to the risk. And that's what I urge you to do. Work out what your scheme's response is going to be. Any personal views you might have on the causes of climate change, or even whether man-made climate change is happening, are of secondary importance. What matters is that the collective belief around climate change risk is going to influence intergovernment policy and the development of alternative energy sources for decades to come. There's a parallel here with liability risk management. Individually, we have no influence on the level of interest rates that determine our pension liability valuations. The setting of interest rates is down to the collective wisdom of central banks and the secondary bond markets. What we control is the response to that risk, i.e. how much liability hedging we put into our portfolios. The same is true for climate change risk. We control the response, not the underlying risk. My second point is really a piece of advice. When debating the subject at trustee meetings, focus on the financial arguments rather than the emotional ones. As a private citizen, I appreciate that the world is tackling the issues caused by global warming. But that's not the focus of my day job as a CIO of a UK pension fund. Sadly, climate change continues to be regarded by many in the investment industry as an ethical investment issue, and Joanne Seegers alluded to that in the session before lunch, and therefore gets prioritised as one. I think that's a financial mistake. Fortunately, there are signs that this is changing, and Kiran mentioned in his introduction the speech that Mark Carney gave as Governor of Bank of England last year. He was highlighting the impact that climate change is already having on the insurance industry. His focus was on the potential impact for financial stability, not the more emotional, ethical issues. So that's all very well, but how do you do this? How do you build a framework for assessing the financial arguments? For my third and final point, let me offer a simple model. Test the financial basis behind any portfolio proposal by asking yourself whether it's going to make money or avoid losing money. It is likely that climate change risk will impact some sectors and asset classes more than others. In my view, understanding the dynamics behind climate change risk is something more likely to be handled better by an active fund manager than within passive index funds. A simple example is the so-called stranded asset theory. The idea goes that some stock valuations are dependent on fossil fuel reserves held deep underground that would never be extracted and sold profitably. Being left as an owner of such stocks means losing money at some point in the future once this risk is fully priced into the markets. I think active fund managers, those who themselves understand climate change risk, are better placed to profit from this. But the issues go beyond a simple active versus passive management debate. So let me leave you with this provocative question. What's your response to climate change risk? Are you going to make money or lose money? Thank you.
Thanks very much, David. I'll hand over to Jane.
Great, thank you very much. I think that the Mercer perspective is very much that climate change has moved from the great uncertainty to a measurable risk. And the framework that we've developed with a number of investors over the last couple of years is a forward-looking one. And of course, one of the challenges around climate is we don't know exactly what will happen. Therefore, it lends itself well to the consideration of different scenarios. So one scenario, and the one that I personally hope for, is that we will follow the 2-degree pathway that Christiana and her team helped to broker as part of the Paris Agreement. And that certainly will have investment implications. There are other scenarios in which we're less successful in terms of mitigating climate. And those different scenarios will have different impacts for investors. So I think from a forward-looking perspective, investors really need to have climate change on their risk registers and have a way strategically to think about what its implications might be. So what I wanted to do in my time now is just show you the implications of one scenario, the 2-degree scenario, on a growth-oriented, globally diversified portfolio. So this first chart here shows kind of a representative asset allocation for a growth-oriented fund. So you can see at the top right, you've got significant allocations to equities. You've got also some private market investments and a significant portion in fixed income. So looking forward over, say, the next 10 years, which I think is a reasonable time frame in terms of thinking about how you're going to allocate within this asset allocation, what types of managers you're going to employ, what your focus will be, is to think about, okay, what would a 2-degree scenario potentially do to average annual returns for each of these different asset classes? So this next chart shows everything that's impacted in these different this asset allocation framework. Everything that's inside the circle has an average annual reduction in returns under this 2-degree scenario, and everything outside the circle sees an increase in returns. Now, of course, we're not certain that the 2-degree scenario will come to pass, but it is one of the possibilities, and therefore this type of analysis can be helpful for investors to say, okay, where do I need to focus my risk management attention? And where can I look for opportunities? So you can see the biggest kind of inside the circle areas are around the developed market equities. Now, this is probably a significant allocation for many of you in the audience. So you would say, okay, 82 basis points annual reduction in return is a really big number. Now, I'm not certain that might happen, but is there something that I can do to hedge against or reduce the impact of that possibility on my future returns? That seems like a very kind of practical risk response. So as Christiana mentioned, one of the things that a number of investors are doing is looking at low carbon versions of broad market indices. The idea being that if you can reduce the carbon footprint associated with a passive portfolio or an active portfolio, then those companies may be better positioned to withstand this, the kind of regulatory environment we'll see under a 2-degree scenario. There are also different approaches around, avoiding investments in certain sectors which will be more sensitive under that type of scenario. So energy, utilities, looking at the types of investments in those sectors to say, how can I hedge against that potential future risk? So there are lots of kind of active and passive risk management opportunities to say, can I take some of that downside potential off the table? Now, where there's risk, there's also opportunity, particularly in the private market side, where you see on the bottom left-hand corner here, there are a number of kind of interesting asset classes. And I should note there are also kind of listed versions of these, which are also, I think, have an interesting value proposition as we transition towards a lower carbon economy. Now, under a 2-degree scenario, and what's driving some of these returns are not only the assumptions around the technology transfer and the technological advancements, but also a stronger regulatory push that will support the swifter transition. So I guess you can see here that there are both risks and opportunities, and you can go through each different scenario and look at how do we align with 2 degrees but also protect against 4 degrees. So really kind of trying to be pragmatic around looking at climate risk as just any other risk is a really important point for investors, investment committees, and trustees to be thinking about. And in closing, I think if those of you haven't yet been approached with the question about how you're managing climate risk, I think that you can expect to be, either from your beneficiaries, from different activist groups, or from regulators. So one of our priorities is helping investors to really think about the best way to answer that question. And there's no right answer. It will depend on your individual structure, your time horizon, the nature of your investments, your beneficiaries. But there are a lot of great tools available now to really think about how to optimize the risk and return equation around climate. I'll leave it with that. Thanks.
Thank you very much, Jane. Donald.
Thank you. Colleagues, may I add my congratulations to Christiana Figueres and the work that UNFCCC had carried out. This has been, the COP21 in Paris has caused, I believe, a seismic shift in the way that the investment world is going to have to look at the issues of climate change and carbon. And I think just within the short to medium term, there are 5, key issues which I think we need to address from a fiduciary point of view. First of all, climate change is a reality accepted by virtually every government. It's not an ethical or a belief-driven issue. Secondly, the implementation of the INDCs, the intended nationally determined contributions, will have far-reaching consequences for pensions regulation, insurance regulation, and financial regulation. Thirdly, implementation of the nationally determined contributions will need the mobilisation and deployment of very significant quantities of private capital. Fourthly, there will be an increasing need by the investment community to measure, monitor, and report on climate change and on carbon. And lastly, I think all of us will experience increased stakeholder and, above all, social pressure for us to report on how we are actually handling those issues. Now, I think everybody at this conference will have fiduciary duty in some shape or form, either to clients or to beneficiaries or to other stakeholders. And therefore, taking climate change and carbon into the investment process, which really is the management of risks and opportunities, is no longer an optional extra. I think David, and I'd like to echo the point that David made earlier in highlighting the financial issues. This is actually being driven not by belief systems, but by financial reality, the risks and the opportunities that this imposes upon us. And we can no more, as fiduciaries, ignore the scientific and ignore scientific advice than we can regulatory or legal advice, because there will be consequences if we do ignore that. So I think every single person in this hall and their organisations have to face up to the reality of that. It's not something that we can duck. And I think the truth of the matter is that while IIGCC now has 120 members, we're a European-based organisation, we operate over 9 European countries, and our members have assets totalling in the order of 13 trillion euros. Until fairly recently, it's only been a relatively small number of asset owners and fund managers who have actively been involved in this issue. And so what we need to do, therefore, is to enlarge the process, to engage with more people. We're already engaged with the policymakers, but we need to engage more with all of the participants in the investment community. And above all, I think it's fair to say that the investment advisors and our professional partners in the actuarial services industries also need to embrace those issues and to ensure that they are providing the right advice and the right analysis to the pension funds and to other asset owners. There is no hiding place nowadays. While the big asset owners have got capacity to deal with those big issues, I think it's fair to say that the small and medium-sized asset owners really need to expect more from their advisors on this, who should be alerting them to opportunities and to challenges. I think there's lots I would like to say, but I just want to finish with this. And that is that asset owners and fund managers really do have a unique opportunity on this issue to make investment decisions that are the right decisions for beneficiaries, but will also help make the step change towards a lower carbon society. And as long-term investors, that can only be in the interests of our beneficiaries as well. So thank you for that.
Thank you very much, Donald. While you all get your vocal cords warmed up for the question and answer session, I think there will be people coming around with microphones. We do actually have one question that's come in from people watching on the live web stream. And if you are watching on the stream, please do send them in. I'm getting them live on here, and I will attempt to get round to all of these questions. This question is from Helene Winch from Low Carbon, who asks for all the panel, and I guess this is the key question we're trying to answer today, how important is it that UK pension schemes increase their investment into renewable energy and other climate solutions? David, maybe you could take that as somebody on the front line himself.
Yeah, I think, as I said earlier, you need to look at the financial risk, and certainly renewable energy is a part of our portfolio. I think the value to us is something, for example, like renewable obligation certificates. So, for example, it gives us a contractual inflation-linked cash flow that is priced better than index-linked gilts. So it's great as a pension fund to have this asset as something that looks like our liabilities, but is providing a more attractive yield. And that's the sort of opportunities that we need to be seeking out that align the interests of the sort of renewable energy sector and what we need as pension funds as assets.
Christiana, it's early days yet, probably after Paris, but have you noticed any change in thinking from the investment managers, the fund managers that you talk to?
There's a fantastic word in German that is jein, which is both yes and no. And I wish it existed in other languages like English and Spanish. The yes is certainly much more awareness. As we've heard from everyone here, much more awareness about the real urgency of assessing risk. But I haven't seen us go beyond the awareness to actually begin to seriously engage in the effort of using the tools that are there, figuring out what other tools need to be done, beginning to look at blending finance, beginning to have conversations with public finance institutions that could help to bring down risk. So, all of those conversations are actually still to be had or more to be had. And frankly, I woke up the day after Paris having swallowed an alarm clock. We have 5 years to turn this huge ship around. And I don't see the urgency being really understood, in particular in the financial world.
Thank you. Donald, the question was actually specifically UK focused. Do you think that the recent actions by the government, certainly on onshore wind and solar, have knocked confidence from the people that you talk to? Is that something they're thinking about, or are most people still thinking of the bigger picture here? As Christiana says, change is coming and you have to react.
Yes, a very good question. In some ways, the UK government has been very positive in this process, and in terms of, along with our European partners, in helping to provide leadership in changing all of this. I think the problem in the UK is, and people will still invest in wind and in solar, but until relatively recently, I think successive UK governments have been best in class in terms of engaging with the asset owners and with the investment community. Looking at what's happened since round about May of last year, I don't want to be too specific about dates here, obviously, but looking at what's happened, I think it's fair to say that there's probably been less consultation, and that people are a little bit more slightly uneasy about that, but that will not deter. I mean, there are tremendous opportunities out there, and pension funds will continue to do what they should be doing. We'll be looking at our carbon exposure, reducing where we can do. We will be hedging against carbon by investment in alternatives like wind farms and solar and so on. There will be greater interconnection opportunities coming through because of the European Energy Union and the Juncker plan. There are some big issues about to roll out and some tremendous opportunities for those who are involved and think about this issue. And so I think engagement and also engagement with energy companies and utilities through our ownership of shareholdings and also the corporate bond holdings. I think engagement with those companies as to what their long-term plans are. Are they going to remain stuck with fossil fuels and die the death as fossil fuels will die inevitably? Or are they going to transform themselves into energy companies in the widest sense of the word and continue to provide community benefit and benefit for investors?
Thanks very much. Jane, you talk in your report last year about future makers and future takers. What does that mean?
Yeah, that's right. It's a great question and relevant actually to Helen's question around infrastructure. So we categorize investors as future takers or future makers. So in a sense, actually, we're all future takers in terms of what happens around climate. Regardless of what happens, it will impact us. And so you can be either climate aware or climate unaware as a future taker. So our view is at a minimum, you need to be a climate aware future taker. One of the very interesting trends over the last few years has been the rise of investors as future makers. So that involves investors using their power as stakeholders and influencers to advocate for a 2-degree outcome. To say, look, we've done the math, we've read the reports, we realize that a 4 or 5 degree warmer world is going to be really bad for capital markets. Therefore, we want to use our influence to try and make sure that that doesn't happen. We're going to be future makers. Now, we've certainly seen more engagement by investors, and groups like IIGCC have been instrumental in kind of helping investors to come together and bring a common message to support the Paris Agreement. I think one of the really great influences into Paris was the fact that investors and companies were exerting their influence and so present in terms of advocating for a 2-degree world. So we've definitely seen investors as future makers kind of flex their muscles on the engagement side. What I think needs to come next for those future makers is to more clearly allocate some of the capital commitments that we will need to see if we're going to actually have the infrastructure that we need to successfully transition. Now, the $1 trillion a year number has been used in terms of the required annual investment in infrastructure and green power and everything globally. What we see today is nowhere near that number. So the question is, where will the money come from, and what investment opportunities exist for investors to pursue that? Now, investors are fiduciaries first, and they need to be good investment opportunities if they're going to pursue them. So I think one of the great challenges and opportunities is which different stakeholders need to come together to make sure that that pipeline is developed, it's available, but it's also a good investment opportunity.
Thanks very much. Do we have any questions from the floor? I think there's one just down at the front here. If you could say who you are first, that'd be great.
Jenny Anderson from the Pensions Trust. I just wonder, Jane, really following up on the point you were just making, is would you recommend for pension funds and other asset owners to set a target on their allocation to kind of green or low carbon assets? Do you think that's a sensible strategy?
Yeah, I think it can be useful in terms of being intentional, in terms of identifying what your aspirations are. And if you look at the kind of Mercer's best-in-class equity portfolio, we have about a 10% target to thematic investments. So investments which will bring a diversification, which are kind of interesting as a theme, and sustainability and kind of climate-related products and services are a great theme that you could put into that bucket. So that might be the type of allocation on the listed side. On the private market side, we also kind of put a lot of effort into finding good opportunities, and I think you could make a similar aspirational target. I think it's interesting, and one of the challenges for many of the stakeholders who are trying to push this forward is there are a lot of investors that are making green investments and not tracking them, because they're just good investment opportunities, right? And you say, well, why aren't you tracking them or reporting on them? And they say, well, we're not making them because they're green. We're making them because they're great opportunities, right? And so I have a lot of time for that, right? So it's a little bit, it can be, I think a lot of investment committees will say, look, I'm not going to put a number against where I want to invest, because if there isn't the opportunity or the pipeline, I'm not just going to put money in anyway, and I don't want to be held to account to something that doesn't make sense. So I think it's a little bit of a fuzzy area, but I think at least tracking it, and this is where you get into being a future taker or a future maker. If you're a future maker and you say, look, we need to make sure there is a pipeline, make sure there's opportunity, meet X amount of dollars into this type of investment, to get there, we need to track it. So I think we need to do some more work around how that happens.
I think it's very helpful helps to set the direction and the tone, but I'm somewhat wary of setting arbitrary, specific numerical targets, because it kind of then the sort of the CO2 emissions target becomes the objective, as opposed to the sound investment of the assets being the objective, from which one should see a reduction in CO2 emissions, but it shouldn't be the primary motivation.
Which is the example that Jane gave of these investments that are not tracked because they don't fall into the conceptual category of these are green investments. They're just very sound investments, right? But I do think that we don't have enough of an effort to tell the stories of how many of these investments are actually being successful. And I do think that there is a barrier there that I would call investor confidence. Because let's face it, these are very new asset classes. They're very, very new. And we've been thinking about them for a long time as being risky technology, politically risky, right? Because many of them are in developing countries. With very high costs of capital. I mean, on and on and on and on, all of the, and we're so used to thinking that they're not competitive against fossil fuels. And when you begin to look at the reality, you see that they are becoming much more competitive against fossil fuels. In fact, very competitive at 3 cents a kilowatt hour now for wind and for solar, that the political risk is being brought down because many of these countries are so intentional about wanting to attract these investments that they're actually giving a protective policy, a content and environment to these investments. And you begin to see that the risks that we have sort of filed away in our thinking closet are actually no longer there or are beginning to diminish. So that's part of the transition also, right? I do think that investor confidence is also in a transition stage, and the more we understand what others are doing, the more it helps to overcome the investor confidence.
Thank you. Are there any other questions from the floor? We have one just in the middle here.
Andrew Richardson, I'm a pension trustee. At the risk of making fairly crude generalisations, if you ask a man or woman in the street whether they are concerned about climate change, they will almost invariably say yes. If you ask them whether they're prepared to pay more for their energy or the petrol in their car to combat that in maybe 20, 30 years' time, they'll have second thoughts about it. So what is the incentive to get those consumers prepared to pay more now against a future risk? And similarly, what are the incentives in a free market capital situation for investors to invest now against risks in 20, 30, 40 years' time, which are subject to even more uncertainties than the other risks we have to manage, such as longevity, interest rates, future returns on investments, and so on?
Thanks very much, Donald.
Well, I think the issue is very similar to insurance risk. The chances of my house burning down are probably less than 1% total catastrophic loss. Yet that does not deter me from paying a contribution towards my house insurance to cover fire. And the reason for that is it's a prudent thing to do. And I think if you look at the example that Warren Buffett used recently, where he talks about the Pascal issue, where if there's 1% chance, I think is what he said, of absolute catastrophic failure, and the failure of the world to continue to exist as we do in humanity and so on, then taking that 1% risk and ignoring it would be is fundamentally flawed. So I think within the investment area, we have to take very, very seriously what the scientists are saying and what is going to happen anyway, because none of us know exactly how this is going to pan out. But the reality is, as a consequence of the Paris summit, all of this stuff will be translated into regulation, and we will have to deal with it. And I think the advantage will go to those asset owners and to those pension funds who get themselves geared up, who want to understand the issues, who will network with other people within their peer group, and who will try and get the best advantage. And that, to me, seems a very, very good reason as to why pension funds should be moving and trying to get in there fairly quickly, so that we do tool ourselves up, we do understand the issues, we do start to monitor, we do start to make the changes that will be necessary to protect our existing investments right across the asset classes. So I hope that goes towards answering your
I do just want to move on a little bit, because there is a question in the audience. There's also quite a good question here. I just want to ask very quickly from Ellen Gibson at 350.org, and this is one specifically to Christiana. You once said academic institutions still vested in fossil fuels should ask themselves whether they're in breach of their social responsibility to serve the community, the nation, and the world. Is the same true of pension funds?
I think so. I really think so, because there is and I'm very glad that Donald talked about fiduciary duty, because I think we have come to the point where we need to decide, do we define fiduciary duty with a small f or with a large f? And we've been defining fiduciary duty with a small f. And I think that, the growing understanding of compounded risks is there, so that we have to actually redefine what we understand as fiduciary duty. And there is no market sector within finance that has more cards in their hands than long-term investors to be able to take the lead on redefining fiduciary duty for the long term. This is exactly where it's at, for the reasons that Donald has just discussed.
And would you go as far as saying that applies to anybody still invested in fossil fuels?
Still invest. You see, fossil fuels is a huge universe, okay? So I don't think that we can be irresponsible about that. But I do think that those who are invested in high cost, high carbon investment should get out of that very quickly, very, very quickly. Because A, we cannot continue to dig up more fossil fuels just because of the loading that we have already done on the atmosphere. And anyway, we have already taken out, we already have existing fossil fuel fields that are on the full spectrum of cost. We cannot go to the deeper cost. So deep drilling, Arctic drilling, tar sands, all of these things that are actually much more difficult and much more expensive just cannot come onto the portfolio. It is absolutely a waste of money, and that really is a breach of fiduciary duty. Those will never be used. Let's understand that. And that doesn't mean that all oil and gas needs to move over immediately. We have to have a smooth transition. We can't take the financial world to a precipice. We can't do the jump to distress that Mark Kennedy is talking about. There has to be a smooth transition, but the transition needs to happen.
Thank you very much. We do have one question here, I think. We're pretty much running out of time, so if you could keep your question brief, and we'll try and keep the answers brief.
Thank you very much. My name is Jim Orr from Lothian Pension Fund. I'm always very interested in panels like these about the difference between the two sort of regulators, as it were, the investment regulator and more the sector industry regulator. And my feeling is that the sector regulation is much more important, frankly, than your side. It's a sector regulator that has the subsidy regime, the incentive regime for investments to be worthwhile. And do you agree with me that really it's the political side on the industry side, which is where the real challenge lies? I think especially, Christina, it's perhaps a question for you, rather than on the investment decision side, because the investment decisions should follow naturally if the regulations are done properly on the industry side.
That's an interesting question. So it shouldn't really be up to the investment community. Regulators and politicians should sort this out.
I think they did. I think government sent a very strong signal. And you know, here's the thing. We cannot continue to play the you first game, right? It's always much, much easier to export responsibility to someone else, either up the value chain or down the value chain, or, just somebody to assume responsibility for this. It just shouldn't be me. The fact is there's shared responsibility here. And I just don't believe that we have the time for very organized, sequential, structuring of decisions that are going to fall along. It just is not going to happen. This has got to be multi-centric decision and transformation in order to get there on time.
Thank you very much. Ladies and gentlemen, just as for me to say thank you for coming along. Thank you to our speakers, to Christiana Figueres, to David Adkins, to Jane Ambachtsheer, to Donald MacDonald. Thank you to you and to those of you watching on the live stream. The message is pretty clear, pretty unified from the panelists here. Climate change is happening. Action to tackle climate change is certainly happening, and it's up to you what you want to do about it. Thank you very much.